The market doesn't panic the way people do. People scream. They freeze. They run for the exits all at once. Markets don't. Markets hesitate. They misprice. They overreact in strange directions. And then, quietly, mechanically, they adjust. That adjustment is where the real story lives. Because when an economic shock hits, what you see on the news is never the full damage. The crash headlines. The red numbers. The fear. What you don't see is the slow rearranging underneath. The invisible math. The uncomfortable trade-offs. The part where the system survives, but not everyone does. That's what we're talking about today. Because right now, shocks aren't rare events anymore. They're background noise. Pandemics. Wars. Inflation spikes. Rate hikes. Supply chains snapping like brittle glass. And every time it happens, we hear the same phrase. The market has already priced it in. That sounds reassuring. It shouldn't. Here's the uncomfortable truth. Markets don't absorb shocks the way a sponge absorbs water. They transfer them. From one asset to another. From one group to another. From the visible to the invisible. And understanding how that transfer works tells you more about the future than any headline ever will. Let's start at the moment of impact. An economic shock is simply something the system didn't expect. A virus shuts down cities. A war cuts off energy. A central bank raises rates faster than anyone modeled. Expectation breaks. And when expectation breaks, prices move. Not because the world changed overnight, but because the story investors were telling themselves no longer makes sense. That's the key thing most explanations miss. Markets are not reacting to reality. They're reacting to the gap between reality and the story. Before the shock, there's a shared narrative. Growth will continue. Rates will stay low. Supply chains will hold. Demand will rebound. Prices are built on that narrative. Stocks, bonds, real estate, currencies. They're all just different expressions of the same collective belief. Then something happens that doesn't fit. And the first move is almost always wrong. That's not an insult to investors. It's a feature of how complex systems behave under stress. The market doesn't calmly reassess fundamentals. It reaches for safety. Risk assets drop. Cash becomes king. Volatility spikes. This is the phase everyone remembers. The crash. The sell-off. The charts that look like elevators with cut cables. But this is only phase 1. And phase 1 is emotional. Fear compresses time. Investors stop asking, "What is this worth over 10 years?" They start asking, "What can I sell right now without destroying myself?" Liquidity matters more than logic. Assets that are easy to sell get sold. Assets that are hard to sell don't move. Yet. That's why early market reactions often look irrational. Good companies fall with bad ones. Long-term investments get punished for short-term uncertainty. Prices overshoot. This is the market shouting before it starts thinking. Then comes the adjustment. Quiet. Slow. Relentless. This is where markets actually process the shock. And this is where the real math shows up. Because every shock forces the system to answer the same brutal question. Who absorbs the loss? Losses don't disappear. They just move. If inflation spikes, someone pays. Consumers pay higher prices. Workers lose purchasing power. Bondholders lose real returns. If rates rise, someone pays. Borrowers face higher costs. Asset prices fall. Future growth gets discounted more aggressively. If supply chains break, someone pays. Companies lose margins. Consumers face shortages. Entire business models stop working. Markets adjust by reallocating pain. And they do it through prices. This is where the phrase, "pricing it in," becomes misleading. Markets don't price in events. They price in consequences. And consequences take time to understand. Early on, investors guess. Later they revise. Then they revise again. This is why you'll often see markets fall, then rally, then fall again. Not because investors are confused, but because the implications keep changing. Let's take interest rates as an example. When rates first rise, the market reacts fast. Growth stocks drop. Tech gets hit. Anything built on future cash flows gets punished. That's the obvious part. But the deeper adjustment happens later. Housing slows. Hiring cools. Debt refinancing becomes painful. Defaults quietly increase. That doesn't show up in earnings immediately. So the market rallies. Looks like we overreacted. Then the data catches up. And the second adjustment begins. This is where irony creeps in. The market often celebrates the shock itself. Before it feels the damage, bad news becomes good news. Layoffs boost stocks. Slower growth sparks rallies. Not because the economy is healthier, but because expectations have dropped lower than reality. This is the cruel elegance of markets. They don't care if things are good or bad. They care if things are better or worse than expected. Now zoom out. After enough time passes, the system starts to rebalance. Capital flows change direction. Risk gets repriced. Entire sectors rise or fall in importance. This is where long-term shifts happen. After major shocks, the economy rarely returns to its previous shape. It reorganizes. After inflation shocks, capital favors pricing power over growth. After credit shocks, balance sheets matter more than narratives. After supply shocks, redundancy becomes more valuable than efficiency. Each shock rewrites the rules slightly. And markets are constantly updating the playbook. But here's the part most people don't like hearing. Markets adjust faster than people. Wages lag prices. Careers lag industries. Policies lag reality. By the time the market has stabilized, many individuals are still absorbing the shock. This creates a disconnect. Markets look calm. Indexes recover. Volatility fades. But underneath, the distribution of wealth, opportunity, and risk has already shifted. Quietly. Permanently. This is why market recoveries can feel surreal. Stocks hit new highs. Meanwhile, households feel poorer. Costs stay elevated. Security feels fragile. The system adjusted. Just not evenly. And this is where hype and reality diverge. The hype says markets are resilient. That they bounce back. That they always recover. Which is technically true, but misleading. Markets don't recover for everyone. They recover in aggregate. They move forward by reallocating resources toward whatever survives the shock best. Sometimes that means innovation. Sometimes it means consolidation. Sometimes it means fewer winners controlling more of the system. Efficiency increases. Competition decreases. That's not ideology. That's math. Shocks accelerate trends that were already underway. They don't create new futures. They pull existing ones forward faster than expected. And markets reward whoever was positioned for that acceleration. Everyone else adapts, or exits. Now here's the unsettling part. The bigger and more frequent the shocks, the more sensitive the system becomes. Each adjustment leaves scars. Higher debt. Less trust. More intervention. More complexity layered on top of old complexity. The system still works, but with less margin for error, which means future shocks hit harder, and adjustments become more abrupt. Markets still don't panic, but they snap faster. This is why volatility feels different now. Moves are sharper. Narratives flip quicker. Confidence disappears overnight. Not because markets are weaker, but because they're more tightly wound. So when people say, "The market has adjusted," what they really mean is this: the market has decided who pays. For now. Because adjustments aren't final. They're provisional. Built on assumptions that will eventually be tested again. And when the next shock arrives, and it will, the process starts over. Prices move. Stories break. Losses transfer. Quietly. Mechanically. Without apology. So here's the question worth sitting with. If markets don't absorb shocks, if they only redistribute them, then when the next adjustment comes, where do you think the weight will land this time?